Much unknown when it comes to inflation and its impact on the American people. So joining us live to help us answer some questions is Associate Professor of Finance and Business Economics from UW, Thomas Gilbert. Thanks so much for joining us.
My pleasure.
You know, right now, reports say that the Federal Reserve might raise interest rates by 3/4 of a point tomorrow. If that does happen, how could that impact the inflation that we're seeing?
It's difficult to know. The inflation, it's important for people to remember that inflation is driven by three factors: demand being too high, supply being too low, and inflation is moving today because of expected future inflation tomorrow, next week, next month. The Fed can't do anything about the supply side. It can't put trucks on the road, but it can affect the demand. So it wants to raise interest rates enough to slow the demand down so that things go back to some kind of normal equilibrium. But demand is so amped up post-pandemic that we're seeing this increase in prices. So they've been saying, okay, we'll raise interest rates by half a percentage point slowly over the next few months. But the inflation numbers are just too high. And they're worried that if they let it going, then the third factor, which is expected future inflation, so prices will rise today because people think prices will rise in the future, that kind of feedback cycle will accelerate and accelerate. And so now they're talking, well, maybe we need to raise more interest rate more today to make borrowing more expensive so that the demand calms down. But it's a very fine line, and it's difficult to know exactly what's going to happen if they do such a move. It would be a divergence from what they've been saying, but they are getting new information in real time and need to adjust potentially.
Well, that would make interest rates at 4%. People are worried about a recession. Do you think if they do this, that's where we're headed?
I mean, equity markets have already, fallen a lot, which would suggest that, prices were too high before, or prospects going forward are not that great. And it is possible. So what the Fed is trying to do is dampen the demand softly so that we don't enter a recession in a rough, harsh way, but it just slows down enough to get back to some equilibrium. But it's a very fine balance to play, and it's trying to put a Band-Aid in real time, and we get new information. The likelihood of a recession, I think, is increasing. Equity markets reflect this. Bond prices falling reflect this. And we'll have to tell. They don't want a recession. They don't want to recreate what happened in the 80s when we had to jack up interest rates like crazy, definitely forcing a recession in order to control inflation. Jerome Powell and his friends don't want to do that. But it's just hard to tell. And it's quite possible that we'll enter a recession in the next 2 quarters.
We keep seeing the stock market getting near bear market territory. What does that mean, and how does that impact the average American?
At some level, one way to look at it from a silver lining, the bear market, the S&P 500 having fallen, plus more than 20% since its year high in January, means equities are cheap. So if people have, cash on the sideline that they're not sure what to do with, maybe that's a good time to move into the markets. What I would say for the average American is that my main piece of advice is do not stop saving. The concern right now is for people to say, well, things are getting more expensive, that's inflation, so I'm gonna save less to maintain my standard of living where it was before. But that, I think, would be a huge mistake. People have to continue saving because saving for retirement and earning these compounded returns over many, many years matters a lot. So does it mean belt tightening right now? Yes, potentially. But I would really strongly advise people not to stop saving just to be able to keep going to the movie theaters, once a week, because this is what I'm used to, even though movie prices are going up.
All right, Thomas Gilbert, the Professor of Finance and Business Economics from UW. We appreciate your insight. We'll see what happens tomorrow. Thank you.